Today, I'm going to be showing you guys the best Solana DeFi yield farming strategy that you can implement into your portfolio to make substantial returns in the next bull run. Let's hop in. So a brief recap of what yield farming actually is. It's essentially taking our assets and putting them to work to earn a passive income. And what I mean by that is if I take Ethereum and USDC and head over to Uniswap on the Ethereum network and I create a concentrated liquidity pool. Say I use a range of something like this. I can now start to earn 88% APR on my Ethereum and my USDC. Now, obviously, that's not risk-free. Obviously, there are a ton of different intricacies in concentrated liquidity that I am not covering right now. But the basis is we are taking our assets, we're putting them to work to earn a passive income on them. Similar to how you can take your dollars, you could throw it into real estate, something that is relatively safe, and earn a passive income off of it. Or you could take your dollars, you could go throw them into a savings account, earn roughly 5%. Once again, passive income. Now, with yield farming, it's a little bit different. Obviously, it's not going to be nearly as passive because the space is a lot more volatile than real estate or just strictly the US dollar. However, the other end of things is with yield farming, you can achieve these substantial returns like 85%, therefore making these returns worth the time that you would put in. And I will say, based on an internal study we did amongst all of our clients that are currently generating 80 to 100% APR, they're currently spending roughly 1 to 2 hours per week on their DeFi portfolio to make that 80 to 100% APR. Looking strictly at DeFi stuff, right? Currently DeFi has a TVL of $55 billion. When we look specifically over at different chains, you can see that Ethereum makes up for roughly $31 billion of that TVL. Tron makes up for roughly $8 billion of that TVL. BSC 3.5, Arbitrum 2.6, but here's where the big player comes in. It is the Solana network coming in at $1.4 billion of TVL, making up for roughly 2% of the overall DeFi industry. Now obviously 2% is not a lot of the overall DeFi industry, but the potential behind this network is what I want to focus on. And it's already starting to show because in the past 1 month, the Solana TVL is up 36%. When you compare that to some of the players that have been in the space for a while, like Ethereum, it's only up 8%. Or in this case scenario, Arbitrum only up 15%, or even Optimism and Polygon up 9% and 3% respectively. And then you look at other networks like Avalanche are actually down 10% in the past month. So obviously TVL is coming into Solana, and it is probably coming from a lot of these other protocols. People are getting off Ethereum and getting on Solana. People are getting off of Arbitrum, getting on Solana. People are getting off of AVAX and getting on Solana because of the technology behind it. And if you guys do want to learn more about the technology of Solana, drop a like and subscribe when notifications turned on, and let me know in the comment section. I will make a dedicated video to the Solana technology. But the basis of Solana network is that it is very, very cheap, right? Ethereum has been around for a very long time, and when Ethereum first came out, it was revolutionary technology. But due to its decentralized nature, it has been very hard to upgrade the technology of Ethereum over time, to the point where when you try to execute a transaction on Ethereum, you're paying $15 to $50 per transaction, which is not sustainable for the real world. That's exactly where Solana comes into play. Coming in with an average cost per transaction of literally less than a penny makes it a lot more sustainable for real world adoption, but also more sustainable for just decentralized finance. Additionally, the technology is very, very fast. It's not like you pay a cent, your transaction goes through tomorrow. No, you pay a cent, your transaction goes through instantly. On the Ethereum network, you tend to wait 1 to 5 minutes for your transaction to go through, depending on what type of transaction it is. So let's specifically look at some different decentralized applications on the Solana network. Obviously, there's platforms like Marinade, Gito, MarginFi, Camino, and BlazeStake, but these are all liquid staking, lending and borrowing, and other different platforms. Their TVL doesn't really count to the overall $1.4 billion because it's not necessarily DeFi stuff. And that's because if you're staking, yes, that's the very, very, very base layer of DeFi as long as you're staking through a decentralized network, but at the same exact time, it is very, very similar to holding, so it is not counted in this TVL. If it was counted in this TVL would probably be about $3 billion at least. But when it comes into the DeFi aspect of things, we have stuff like Orca, Solend, Radium, Drift, and some other protocols. The first protocol I'm going to go over is Orca. And Orca is a decentralized exchange, and I will mention I absolutely hate their UI. But it is very, very simple and very easy to use. If you're a trader, you can simply buy one asset with another asset, similar to what you can do over on Uniswap. You can swap one asset for another asset. That's the basis of what you're doing here. Now, if you're a liquidity provider, you can earn the passive income from people actually trading these assets. And what I mean by that is if we go over to liquidity, it's going to open up a new tab, and here it's going to show us a plethora of different liquidity pools that we can deposit our capital into in our crypto assets. Remember, yield farming is putting our crypto assets to work to earn a passive income on it, similar to how we would put our dollars to work to earn a passive income. So if we provide liquidity for SOL to USDC, we could be earning 0.233% per day. Now, obviously, we can make that a lot higher if we go with a narrower range, or we can make it a lot lower if we don't go with a narrow range whatsoever. So for example, if we go over here and we choose custom, right off the bat, we're getting 0.1% basically. However, when we start to narrow down our range and say maybe we don't think Solana is going to go below $85, until a long time from now. And maybe we think in the foreseeable future it's going to take a long time for SOL to get to $130. We're basically thinking that the Solana run has kind of cooled off. Maybe there's a retracement, but for the most part it's going to sit at current price, if not go up a little bit. This gets us 0.2%. And this range, we probably wouldn't have to touch for roughly 2 to 3 weeks. However, if we were to dive a little bit deeper, maybe we want to touch this range next week and we want to actually adjust our pool so we can continue to be in range. Well, then we might do something like 90, or if we're even feeling a little bit risky, we could do 93, not allow for really any downside exposure on SOL, and then our max price we can bring down to like 120, or if we're feeling a little bit more risky, we could do 110. And then that allows Solana to go down 4% and allows it to go up 13%. And here we're making 0.5% per day. That is absolutely nuts. Now, obviously, if we go out of range, we're going to have two different things. Number one, impermanent loss, but number two, we are no longer going to be earning fees. And that's the basis of concentrated liquidity. We have tons of videos on the channel if you guys do want to learn more about concentrated liquidity. However, we also have a $35 Uniswap V3 mini course. Now, Uniswap V3 essentially created concentrated liquidity. This is the first we've ever seen of concentrated liquidity, but what I personally think you should look into is our Uniswap V3 concentrated liquidity course. It is currently only $35 on sale, but obviously this is tailored to Uniswap V3. However, when you think about it, Uniswap V3 is essentially the founding fathers of concentrated liquidity. They created this concept. The same exact fundamentals that we teach in this concentrated liquidity mini course can be applied to Orca, they can be applied to Radium, they can be applied to any other concentrated liquidity decentralized exchange. We go over how to find high performing pools, we go over how to choose the ranges for those pools, how to rebalance those pools to minimize impermanent loss, and of course how to actually avoid impermanent loss. And then obviously we go over in depth what concentrated liquidity actually is. But as you can see, over 258 people have already taken advantage of that sale, and we are going to be hosting an exclusive webinar to these people relatively soon. We're also working on a Solana yield farming mini course, and the people that are in our Uniswap V3 mini course are going to get an exclusive discount to that. Once again, there's a community aspect here, so if you have questions, you can feel free to ask them. And if you're looking to work one-on-one with us, we do have an opportunity that is available. We've already worked one-on-one with 50 different people, making collectively over $100,000 in passive income per month. But getting back on topic, I want to talk about Solent. This is a lending and borrowing platform where essentially you can collateralize some assets and borrow some assets. So maybe I'm staking SOL, but I want to leverage up in a sense. And what I mean by that is my SOL is currently just earning maybe 10% because I'm staking it. Well, I can then go and collateralize my SOL on Solent and I can borrow a USDC. So I would then go collateralize my stake SOL, which is MSOL down here, and then I would borrow USDC, maybe at a 50% loan to value rate. So if I collateralize $10,000 of SOL, maybe I borrow $5,000 of USDC. I can then go and take that USDC, go throw it in a liquidity pool, or I should say a concentrated liquidity pool on Orca. Currently, this one right here with USDC and USDT is doing 10% per year, which isn't bad whatsoever, considering this is capital that was not going to be used. And that's double what you get in the United States markets right now. Now, currently on Francium, you could get a 14% APY by collateralizing USDC, or a 14% APY by collateralizing USDT. Once again, that is nearly 3 times the market rate that you get in the United States, and it is completely liquid. You can withdraw at any given time. These stablecoins are collateralized by actual US dollars in banks. The point here is with Solent, if you're borrowing USDC at maybe even a high APR of 8% right here, and then let's just say you're taking that USDC and throwing it in here for 14%, well then your net is 6%, and you're borrowing at a 50% loan to value ratio, so on your overall SOL, you're essentially getting an additional 3%. If you're staking for 10%, you're now getting roughly 13%. Which is a killer strategy to essentially leverage up in a very, very safe way. And if you guys do want to be a little bit more riskier, well then you could borrow USDC on Solent and you can take that and you can convert half of it to SOL. And when you convert half of it to SOL, you can then go and throw it in Orca, doing 200% on SOL to USDC. Now ultimately this is a riskier strategy if in case SOL does go down. If it goes up, then it's going to be very, very profitable. But if it goes down, then you all of a sudden have to repay some of that debt using your initial SOL position, which is why I recommend only doing stablecoin loans and taking that and putting that into stablecoin positions. That's what I do in my personal portfolio. Now, there's a platform called Drift. Now, Drift is actually pretty interesting because it's a decentralized derivative market. That means that you can do longs, you can do shorts, and you can do those with leverage, completely decentralized directly from your wallet without having to do any KYC. We have seen this in other different networks, like the Arbitrum network, where we see GMX, or even synthetics on Ethereum mainnet, or something along those lines. Currently, GMX has a TVL of $620 million. That's because people want to do these leverage trades no matter what. And instead of going on a centralized exchange like Coinbase or Binance, where there's heavy restrictions, KYC requirements, and of course, there could even be slippage issues, they go directly to GMX, or they go to Drift, or something along those lines. Looking over at Drift, there are opportunities to earn passive income on here by actually providing liquidity for this decentralized exchange. Now, in this scenario, you do have counterparty risk. That means that you're essentially paying out the trader's wins, but that also means that you're getting paid when traders lose. Now, these positions are doing crazy. Like in the past 7 days, this position performing 33%. But remember, you're essentially taking the other end of a trade. So if somebody's long, you're short. If somebody's short, you're long. So you do need to keep that in mind. And this isn't just something that you could throw your money in, expect it to be 100% passive, because you are going to lose sometimes. This is going to be more of a trading strategy as opposed to an actual passive income strategy. As you can see, a lot of these have won in the past 30 days, but when we look specifically at some like Ethereum, you could see 30-day return is 25%, but 7-day return is negative 6%, because you can lose money here since you are the counterparty to trades. Same thing with H&T. 30-day is profitable, but 7-day is not. And you look specifically at some of these other assets, it's going to be completely vice versa, like ARB-Perp. It's profitable in the past 7 days, but it's not profitable in the past 30 days. So it's important to do some technical analysis and actually know what you're investing into when it comes to these Drift liquidity pools. They also have different passive income opportunities like the insurance fund vault, where essentially you're underwriting insurance, I guess you could say. And of course, you can always withdraw your capital unless it comes to a point where the insurance fund actually has to be used, then that's put on you. And you have to deposit into here knowing that you're taking that risk. Or they also just have an ordinary lending and borrowing market, kind of like what we talked about with Solana, but the APRs are a lot more favorable. For example, we could borrow USDC for 5.6% as opposed to having to pay roughly 7.3%. There's a lot of different opportunities in the Solana network, and personally, I've migrated essentially half of my portfolio from Ethereum-based chains, or I should say EVM chains, over to the Solana network, because there are so many opportunities there right now, and me and my clients have been making a ton of money from that. Remember, don't forget to check out that Uniswap V3 mini course. It's on sale for a limited time. Once we release this Solana yield farming course, we are going to be upping the price of the Uniswap V3 mini course, but of course, those that are already in the mini course are going to get an exclusive discount to this new Solana yield farming course. And once again, if you enjoyed, drop a like, subscribe, and notifications turned on. I'll see you guys in the next video. Peace out.